This week, global markets operated in a complete fundamental vacuum, allowing technical momentum to dictate price action. Without fresh geopolitical catalysts to stoke supply-side fears, the prevailing risk premium rapidly unwound. Welcome to the D-Risk Weekly Global Markets Brief. It's Saturday, July 4th, 2026. Our theme of the week is the quiet melt-up. Across global exchanges, we are seeing a distinct lack of escalatory developments, creating a quiet window that allows markets to shed their defensive postures. The biggest dislocation in macro markets right now is how aggressively equities are bidding up in a low liquidity holiday environment, completely ignoring the persistently restrictive bond market. Investors are treating the absence of bad news as a green light to buy. Alex, let's start with the international picture. Asia and Europe.
Thanks, Sarah. The quiet melt-up is driving sharp technical extensions across international equities, creating distinct regional narratives. Starting in Asia, the Nikkei edged up 0.55% on the week, closing at 69,744. Without fresh fundamental news to disrupt the market, buyers simply supported the established upward trajectory. Conversely, the Hang Seng rallied 2.99% to close at 23,350, but this was purely a technical relief bounce. The structural posture remains broken, as a death cross actively suppresses the market. The 50-day moving average at 25,121 sits firmly below the 200-day at 25,896, confirming the broader downtrend. Moving to Europe, the momentum was explosive. Germany's DAX surged 4.49% to close at 25,779. Operating in a complete fundamental vacuum, systematic trend-following inflows propelled the German benchmark higher. Meanwhile, the UK's FTSE 100 rallied 1.63% to close at 10,679. A weaker-than-expected U.S. jobs report eased global rate concerns, providing the catalyst for European equities to break out. This global momentum successfully offset domestic headwinds, including a contraction in the UK services sector. Sarah, when the news cycle goes quiet, technical positioning takes the wheel.
That explosive European breakout perfectly illustrates how eager capital is to deploy when headline risks fade, Alex. But if international markets are surging on the back of cooling U.S. rate expectations, is the American tech sector leading this low liquidity charge, or are domestic indices showing signs of exhaustion? Alex, break down the U.S. and cross-asset signals.
The American tech sector is absolutely leading the charge, Sarah. In a low liquidity holiday session, the Nasdaq 100 futures rallied 1.17% this week, closing at 29,902. The broader S&P 500 futures drifted higher by 0.38% to close at 75.57. This tech-led outperformance confirms our quiet melt-up theme, driven entirely by technical positioning rather than new macroeconomic inputs. Looking at the plumbing, we are flying blind on the 2-year Treasury this week, so we will focus on the long end. The 10-year yield remains elevated, closing at 4.48%. Investors are comfortably absorbing this higher rate environment without significant distress. In the currency space, the U.S. dollar index edged down 0.50% to close at 100.86. The dollar is simply consolidating, maintaining a bullish golden cross. The 50-day moving average at 99.50 holds above the 200-day at 98.86, preserving the structural uptrend. The most critical signals are flashing in commodities. Crude oil edged down 0.65% to close at 69, entirely unwinding its recent geopolitical risk premium. We must note a dangerous technical divergence here. While a golden cross remains technically active, the price has collapsed well below both the 50-day moving average at 90 and the 200-day at 74. A golden cross with price below both averages is a breakdown condition, not a bullish confirmation. Meanwhile, gold rallied 2.66% to close at 4,187, catching a bid as U.S. rate hike odds softened. Finally, the VIX slid 2.65% to 16.15, signaling that fear is leaving the market and confirming a broad risk-on sentiment. Sarah, back to you.
Thanks, Alex. That structural breakdown in crude oil, contrasted with the tech-led equity advance, finalizes our quiet melt-up theme. The market is aggressively bidding up risk assets while simultaneously pricing out geopolitical and inflation fears. Looking ahead, this technical momentum will face a severe fundamental reality check. Next week, traders will scrutinize the ISM Services PMI and the FOMC minutes for any signs of economic deterioration. In Europe, ECB President Lagarde's speech will be critical for currency markets. If the ISM Services data reveals unexpected weakness, the immediate vulnerability is the Nasdaq 100 at that 29,902 level, as low liquidity gains could rapidly reverse. That's all for this week's episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in, and catch you in the next episode.